Welcome back to the Pro Ticker Podcast, everyone. Your Friday morning edition covering major financial magazine headlines. We've got a really interesting stack of articles today. A little bit nerve-wracking, maybe, but fascinating look at where things might be headed. So let's dive in and see what we can learn about 2025, shall we?
Sounds good to me. Let's do it.
Okay, well, this piece on Apple in Barron's really caught my eye. They're talking about a potential golden era of growth driven by AI. Wedbush analysts are predicting Apple's market cap could go past $4 trillion, driven by the latest iPhone operating system, a massive upgrade cycle, and get this, hundreds of AI-powered apps in development.
Wow, that's a pretty bold prediction. A lot riding on whether Apple can actually make money off of all these AI features. We've seen flashy tech fizzle before.
Right, so will people actually pay for AI logi generation or a ChatGPT-powered Siri? Yeah, good point. It has to be more than just a novelty. People need to see real value in those AI applications. And speaking of value, Wedbush analyst Daniel Ives, he's usually pretty bullish on Apple anyway, but he's raised his price target to $325, a Wall Street high. He seems to think the potential of these AI-enhanced iPhones is being underestimated.
He's definitely putting his money where his mouth is. But even with all this AI optimism, we've got to look at the other side of the coin, too. BTX strategist Jonathan Krinsky, he points out that Apple's recent stock performance, 5 straight weeks of gains, 2% or more each week. We haven't seen a streak like that since 2010. And historically, that kind of run has been followed by negative returns in January.
So it's like this potential AI slingshot effect versus the weight of historical stock market trends. I wonder if maybe those two forces could balance each other out in some way.
It's possible, for sure. It reminds us that even with amazing technology, market forces, and how investors feel, that still plays a big role.
Absolutely. Okay, let's move from tech to something that feels a little bit like the Wild West. Bitcoin. Barron's says Bitcoin is on track for a second week of losses, but still set to end 2024, up over 100%.
Yeah, Bitcoin's always been volatile. But this is interesting because of all the talk about President-elect Trump and what he'll do about cryptocurrency.
Exactly. There's so much buzz about those campaign promises to deregulate crypto and even create a national reserve of Bitcoin. I have to admit that one really made me scratch my head. What would a national reserve of Bitcoin even look like? How do you create a reserve for something that's so decentralized and unpredictable?
Yeah, it's totally uncharted territory. The logistics would be mind-boggling. Just imagine the regulations, the potential for manipulation, and how do you even put a value on something as volatile as Bitcoin, not to mention the impact on the U.S. dollar.
It's almost like trying to catch lightning in a bottle. And speaking of unpredictable things, let's talk about the bond market. Barron's is calling it a knife fight between the bond market and the Federal Reserve.
This is where things get really interesting. The Fed's been cutting rates, but long-term bond yields have been rising. It's a sign that the market doesn't agree with what the Fed is doing.
So it's like the bond market is basically giving the Fed the finger.
You could say that. When yields go up, even though rates are being cut, it means investors think inflation is coming. They're saying they don't believe the Fed can keep prices under control.
And why would they think that?
Well, analysts like Jim Bianco of Bianco Research, he's quoted in this Barron's article. He says the Fed is making a mistake easing up on monetary policy, especially now with the economy doing well and the potential for Trump stimulus to make inflation even worse. They think the Fed is underestimating how much pressure is building for prices to go up.
So what does this mean for the average investor? Are we all just strapped into a roller coaster headed for a bond market crash?
Not necessarily, but it does mean things could get bumpy. This disagreement between the Fed and the market creates uncertainty, volatility, and it's a good reminder that even when the economy seems strong, there are always risks.
Okay, so we've got AI potentially driving huge growth for Apple, a national reserve of Bitcoin, that sounds like science fiction, and a bond market that's playing chicken with the Fed. Anything else we need to add to our 2025 economic bingo card?
We can't forget about the warning signs coming from the global economy. For that, we'll turn to Bloomberg first. China's industrial profits are on track for their biggest annual drop since 2000. That's a sign of some serious problems in the world's second largest economy.
Yikes. It makes you wonder if a struggling China could have a domino effect on the rest of the world.
Definitely a risk. If China slows down, it could affect demand for goods and services around the world, leading to slower growth in other countries.
And on top of that, Bloomberg says European natural gas prices have jumped. Putin's casting doubt on that deal to keep gas flowing to Europe through Ukraine. With winter coming, that's not good news at all.
It just adds to the uncertainty in the energy market. Europe really depends on Russian gas. Any disruption to that supply could have a big impact on their economies and energy prices.
And to complete this trifecta of global economic worries, Bloomberg highlights the UK. where the number of retailers in serious financial trouble surged 25% this past quarter. It seems like economic headwinds are blowing everywhere we look.
Yeah, taken together, these signals paint a picture of a fragile and uncertain global economy. If these trends continue, we could be looking at a slowdown, maybe even a recession.
All right, so some potentially major global challenges to consider. But what about closer to home? What's going on with the U.S. housing market?
Well, according to Barron's, U.S. mortgage rates are ending 2024 higher than they started, driven by rising Treasury yields and the expectation that the Fed won't be cutting rates as much in 2025.
So not what people hoping to buy a house wanted to hear.
It's definitely not ideal for buyers right now. Higher mortgage rates mean it costs more to borrow money, so some people might get priced out of the market or they might have to settle for a smaller house than they wanted.
But is there any hope for people who want to buy a home?
Some analysts think mortgage rates might ease up in 2025, creating opportunities for buyers who are patient and ready to jump in.
Okay, so maybe there's still hope for the homeownership dream.
Yeah.
But if you're thinking about buying, what are some of the key things you should be watching?
Inflation is a big one. If inflation stays high or goes even higher, that could push mortgage rates up. You also have to watch what the Fed does. Will they keep cutting rates? Or will they change course and start raising rates to fight inflation? And of course, the overall health of the economy matters. A strong economy with lots of jobs tends to help the housing market.
So it's a lot of watching and waiting and hoping for the best?
In a way, yes. But it's also about being informed and proactive. Understanding the things that affect the housing market can help you make better decisions, whether you're buying, selling, or just trying to understand the bigger picture.
That's good advice.
Yeah.
Okay, we've talked about Apple, Bitcoin, the bond market, global economic signals, and the U.S. housing market. It feels like we've barely scratched the surface of all the information in these articles.
We've definitely hit on some major themes, but there's so much more to explore. And I think the big takeaway here is change and uncertainty.
I agree. It's like we're at this crossroads, with technology changing the game, economic headwinds, and all these political transitions happening at the same time. It's exciting, but also a little scary. But hey, at least we have each other and this stack of financial news to help us figure it all out.
That's the spirit. Knowledge is power, especially when things are changing. The more we understand about what's happening, the better we can prepare and make good decisions.
Well said. Now let's dig back into these articles. I think there are a few more fascinating insights waiting for us.
Speaking of insights, let's go back to Apple for a second. We talked about those AI-powered apps. But this MarketWatch article, it goes into some specifics that could really impact Apple's bottom line.
Okay, I'm listening. What kind of apps are we talking about?
Think about personalized health monitoring, AI-driven investment advice, even interactive educational tools, all built right into the Apple ecosystem. This isn't just about fancy emojis. It's using AI to make their existing services even better and to create totally new ones.
That makes a lot more sense than just saying hundreds of apps. And it makes that potential for billions in revenue seem a lot more real.
Exactly. It's not just how many apps, but how good they are.
Yeah.
And the value they bring to people.
Okay, so Apple's using AI to maybe change everything from healthcare to education. But what about other companies jumping on the AI bandwagon? We have an article here about Palantir, also from MarketWatch.
Oh yeah, Palantir. Yeah. That data analytics and software company. Their stock has been on fire this year, even beating the most optimistic analysts' price targets.
Wow, that's impressive. So what's driving that? Is it all just AI hype? Or is there something more to Palantir's success?
It's probably a mix of things. The excitement about AI definitely plays a part. But Palantir has also landed some big contracts with the government and with businesses, showing that their technology has real-world applications.
That makes sense. But this article also says that even the most optimistic analysts are starting to get a little cautious. What's that about?
Well, even Dan Ives from Wedbush, the same analyst who's so bullish on Apple, he admits that Palantir's stock is trading at a really high multiple right now, meaning investors are paying a lot for each dollar of earnings. Some analysts think that's not sustainable in the long run.
So it's like the stock price has gotten ahead of itself? Blown it by the AI bubble?
It's possible, and it shows why it's important to look past the hype and really understand a company's fundamentals, like how much their earnings are growing, their profitability, and who their competitors are.
Good point. Okay, let's switch gears again and talk about the U.S. economy overall. We have an article here from the Wall Street Journal that says the U.S. could be on the verge of a productivity boom. That sounds like good news, especially after all the economic doom and gloom we've been talking about.
Yeah, it could be great news. Productivity growth is essential for the economy to be healthy in the long term. It means we can produce more stuff with the same amount of resources, which can lead to higher wages. a better standard of living, and it can even help with that growing national debt.
So what's causing this potential productivity boom? Is it another AI miracle?
AI probably has something to do with it. But the article mentions a few other things. One is that workers are being matched to jobs better in this post-pandemic world. As companies adjust to new ways of working, they're finding more efficient ways to use their employees.
So it's like the pandemic forced companies to rethink how they do things, and they stumbled upon some hidden productivity treasures.
You could say that. Another factor is that companies are investing more in technology that saves labor, automating tasks and making workers more efficient.
So we've got a more adaptable workforce, smarter technology, and of course AI looming on the horizon, ready to boost productivity even more. Sounds like a recipe for economic success.
It definitely has potential, but like with any economic prediction, there are always things we can't be sure about.
True. But let's try to be optimistic for a minute. Let's say this productivity boom actually happens. What kind of impact could it have on the average American?
Well, in theory, increased productivity could mean higher wages because companies would share those efficiency gains with their workers. It could also mean lower prices because businesses could pass their savings on to consumers. And a stronger economy could create more jobs and opportunities.
So a win-win-win situation.
In a perfect world, yes. But economics is rarely that simple.
Fair enough. Okay, we've looked at Apple's AI plans, the possibility of a national reserve of Bitcoin, the bond market standoff with the Fed, and now a potential productivity boom in the U.S. What's next on our financial adventure?
Well, since we've been talking about the bond market and those rising yields, we should probably take a look at some strategies for dealing with all that turbulence. Barron's has some ideas.
Okay, what does Barron's recommend?
They suggest looking beyond those long-term treasury bonds. They've been hit hard by the rising yields. Instead, they recommend some alternative investments that can give you good returns without as much risk from interest rates.
So if we're not putting all our money in long-term treasuries, where should we be looking?
One option is corporate bonds. They're paying over 5% right now. And you don't have to go into the really risky junk bond territory to get that.
Corporate bonds. Less risk, still decent returns. What else is there?
The article also mentions CLOs, collateralized loan obligations. Those can pay even more, but they're more complicated and potentially riskier.
CLOs. That rings a bell, but I can't quite remember. Can you give us a quick explanation?
Sure, CLOs are basically bundles of loans made to companies, often companies with lower credit ratings. Those loans get packaged together and sold to investors, with different parts offering different levels of risk and return.
So it's like a diversified portfolio of company loans.
Kinda, but CLOs can be pretty complex. You really need to understand the risks before you invest.
Got it. Any other alternative investments worth looking at?
The article also talks about junk bonds, which are bonds from companies with not-so-great credit ratings, and preferred securities, which are kind of a mix between stocks and bonds. Both of those are doing well right now thanks to the strong economy and low default rates.
So it sounds like there are plenty of options for investors who want good returns. As long as they're willing to diversify and be smart about risk, it's like a financial buffet out there.
That's a good way to put it. But just like at a buffet, choose your investments carefully. And don't overload on anything too risky.
Great advice. And speaking of overloading, I think it's time for us to take a break from this financial feast. We've covered a lot today. From Apple and AI to the bond market's dance with the Fed, we've looked at the global economy and even caught a glimpse of a possible productivity boom on the horizon.
It's been a whirlwind tour of the financial world, full of opportunities and challenges, and it seems pretty clear that 2025 is going to be a big year, full of unknowns, but also a lot of potential for exciting developments.
Totally. But before we get carried away with predictions, let's think about what all this means for our listeners. Given all the mixed signals and uncertainty we've talked about, what can you, the listener, do to prepare for what's coming in 2025?
Well, that's the big question, isn't it? I think the first thing is to stay informed. Keep up with the news, read articles like the ones we've been talking about today, and just learn about what's happening in the economy.
So no burying our heads in the sand, hoping it all just goes away.
Exactly. The more you know, the better decisions you can make. And speaking of decisions, be proactive. Don't wait for things to happen. Think about your goals, how much risk you're comfortable with, and how to set yourself up for success, even with all these changes.
That sounds a lot better than just letting the market push you around.
It is. And remember, there's no one right way to plan your finances. What works for one person might not work for another.
So no magic formulas. No get-rich-quick schemes.
Nope, afraid not. The best thing to do is research. Talk to a financial advisor if you need to, and make choices that fit your own situation and goals.
Okay, stay informed, be proactive, and make it personal. Any other wisdom you want to share before we wrap up?
Well, we've talked about it a few times, but it's worth repeating. Diversification is so important. Don't put all your eggs in one basket. Spread your investments across different types of assets, different industries, different parts of the world. That way you can reduce risk and take advantage of opportunities wherever they pop up.
It's like that saying, don't bet the farm on one horse.
Exactly. A well-diversified portfolio is like a balanced diet for your money.
I like that. So to sum up our deep dive into the headlines, stay informed, be proactive, diversify, and personalize your strategy.
Oh.
And don't panic.
Well said. The financial world can be a wild ride, but with the right knowledge and a good plan, you can make it work for you.
That's good to hear.
Oh.
Well, everyone, that wraps up another Pro Ticker podcast, your Friday morning deep dive into the financial headlines. It's been an exciting, insightful, and sometimes a little scary trip through the markets.
It has. But we've found some potential bright spots even with all the uncertainty. And I think we can all agree 2025 is going to be a year to watch, full of challenges and opportunities.
Absolutely. So to our listeners, stay tuned, stay curious, and keep learning. We'll see you tomorrow morning with a fresh batch of headlines from those major financial magazines.